Picture this. It's a Tuesday evening in February. The mascot is sitting at his kitchen table with his RRSP statement open. It came in the mail. He hasn't read one of these in a while. He just sets them aside every year because the number is going up, and he figures that means things are fine. But tonight, for whatever reason, he actually reads it. Annual return last year, 4.8%. That feels lower than he expected. The market had a decent year. He vaguely remembers seeing something about the TSX being up close to 7%. He keeps reading. Management expense ratio, 2.23%. He's been investing for 12 years. He has never looked at that line before. He doesn't know what it means. He Googles it, and he sits there for a long time after that. My name's not important. I'm not a financial advisor, and this isn't financial advice. I'm just a guy who runs the numbers and shows you what they say. If you've ever wondered why your investment returns feel smaller than the market, today we find out. Here's the pitch every Canadian mutual fund investor has heard at some point. It's only a 2% fee. That's nothing. The fund professionals are handling everything. Research, trading, management. 2% is a small price to pay for expertise. And if you heard that and shrugged, you're not stupid. 2% sounds small. It sounds like a rounding error. We tip more than 2% at restaurants. But here's the thing they don't explain. That 2% isn't taken from your annual return. It's taken from your total balance. Every single year. Whether the fund made money or lost money, whether the market is booming or crashing, doesn't matter. They get their 2% off the top of everything you've accumulated. Every dollar you ever put in. Every dollar of growth. Before you see a cent of it. And that changes the math completely. Let's run it. You put $500 a month into your investments. Consistent. Every month for 25 years. That's $150,000 of your own money contributed. The market earns 7% per year on average. A conservative, historically reasonable long-run return for a broad market index. If you're in an index ETF charging 0.20% per year, which is typical for a low-cost broad market fund, your net return is 6.8%. After 25 years, you have $392,760. Not bad. Boring, patient, and nearly $393,000. Now, same $500 a month, same 25 years, same 7% market. But you're in a typical Canadian mutual fund charging 2.2% per year. Your net return is 4.8%. After 25 years, $289,150. You contributed $150,000 of your own money. The market earned 7%, and you ended up with $289,000. That's $103,610 less than the index investor, just from the fee difference. $104,000. That's not a rounding error. That's a car. That's 2 years of retirement income. That's the renovation you keep putting off. Gone. Not lost in the market, just quietly redirected to the fund company every single year for 25 years, while you weren't looking at that line on your statement. And we're only talking about $500 a month. The more you contribute, the bigger the gap. Most personal finance content stops at the math and says, fees are bad, buy cheaper funds. But there's a part of this story nobody wants to say out loud. That 2.2% doesn't just go to the fund company to pay for their research and trading. A piece of it, it's called a trailing commission, or trailer fee, flows directly back to the advisor who sold you the fund. Every year, as long as you hold it. It's baked into the MER. You don't see it as a separate charge. It just happens, invisibly, in the background. Your advisor isn't charging you a bill. They're receiving an ongoing payment, funded by you, processed by the fund company, for keeping you invested in that product. Think about what that incentive structure creates. Every time they review your portfolio and could move you to something cheaper, they lose income. The advice isn't free. You just can't see the invoice. This isn't illegal. It's not even hidden. It's disclosed in fund documents almost nobody reads. But it is a conflict of interest, and it quietly shapes which products get recommended to millions of Canadians. Okay, but my fund actually beats the market. My advisor picks good ones. Here's what the data says. SPIVA Canada, which tracks how actively managed funds perform versus their benchmark indexes, has been publishing this data for decades. Over a 20-year period, more than 90% of Canadian equity funds underperform their benchmark index. Not 50%, not 60%, more than 90%. The few that do outperform in one decade rarely repeat it in the next, and you won't know in advance which ones those are. Neither will your advisor. The market is brutally competitive. Thousands of professionals are analyzing the same stocks with the same data. For one fund manager to consistently beat the index, they'd need to be right more often than nearly every other professional in the world, every year, for decades. It happens. It's just rare enough that betting on it and paying 2% per year for the privilege is a losing strategy for almost everyone. The alternative is deliberately, aggressively boring. Open a self-directed brokerage account at any major Canadian financial institution. Takes about 15 minutes. Transfer your existing investments or start fresh. Buy one broadly diversified index ETF, something that tracks the Canadian market, the US market, or both. The MER on these funds is typically around 0.20% or less. You don't need to pick stocks. You don't need to time the market. You don't need to watch anything. You just buy the whole market cheaply and hold. That's it. That's the strategy. It's embarrassingly simple. It's also what the math says works. The mascot in Mississauga with his February statement, he didn't lose his money in a crash. He didn't make a bad bet. He just didn't know what that line meant for 12 years. Now he does. That's what this channel is about. Not tips, not tricks. Just the numbers the financial industry would rather you run on your own time, so you can decide for yourself what to do with them. If you're in a mutual fund with a 2% plus MER, go look at that line on your statement tonight. Then look up what a low-cost index ETF charges. The difference is sitting in a number most people have never read. The boring one wins. See you next week.